Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Hello, and welcome back to the Second Bite Podcast. We are bringing back our PE Insight series. I did this a couple of years ago, and it was clearly one of our most popular segments that we have done on the Second Bite Podcast. And it's thematically based. So I'm going to ask a question to 5 or 6 private equity folks that are very successful in the lower middle market. And we'll ask the question, and then each of the guests will answer the same question. And we've just got them all in a row here. So I hope you like this. We got great feedback before. Thank you to our sponsor, the good folks at Tower Partners, for making the podcast successful and available. If you have any questions, comments, or suggestions for guests that you think would be interesting, please reach out and let me know. So the question for our guest today is, when you're underwriting a platform investment, how much of your return is driven by the business itself versus your future ability to execute tuck-ins? And what have you gotten wrong around this in the past? Here was our feedback. Larry Shagrin from Mill Pond. What insights can you offer there?
Yeah, sure. So look, when we're underwriting, we primarily underwrite a Mill Pond based case on organic growth. And we look at the organic growth drivers as the core return parameters that we're typically pricing off of. And then we'll look at M&A opportunities. We look at it in every transaction, and we've done, probably, on average 2 to 3 add-ons per portfolio company we've acquired. But we don't underwrite that day one. As you know, they're unpredictable in terms of timing. And we view that as sort of upside to a standard base case. Now, obviously, the level of M&A opportunity could drive sort of that base case return parameters, but we're really looking at an organic basis, what's most predictable, and that's what we're most focused on. Look, I mean, I think where things have not panned out in the past, again, luckily it's been a small number of cases, but I think where we've gotten burned is primarily around just customer churn, and primarily really at that smaller end of like the SMB market is probably where we're most sensitive, Todd, because there we've had situations where we've nailed the end market, we've nailed the value proposition, but the customer base is such that for a lot of things outside of your control, you're going to churn, which puts just a lot of pressure on the customer acquisition engine and impacts your ability to grow and build something that's sustainable and predictable to the level we want when we're looking to sell these businesses.
Good insight, Larry Shagrin. Thank you. Tommy Cooperrider from Dynamic Core. How do you guys think about that?
It's something we struggle with, all the time at Dynamic Core, right? How much of the strategy is being driven by the tuck-ins versus the platform? Our viewpoint on it is that tuck-ins are great tools, but only if you use them correctly. The best value you get from a tuck-in, from our perspective, is selectively using them to add capabilities to the platform. It is allowing, using a tuck-in to get into a new end market that is highly complementary to an existing end market. It's using a tuck-in to adding a new service that you could cross-sell into your customers from day one. And yeah, maybe you could do that organically and launch a new service, but how long is that going to take you? 9, 12, 18 months versus doing an acquisition in 3, 4, 5 months, and then having some scale that comes with it and being able to execute on it well right away. I think that can be a game changer. When we've gotten it wrong, it's not having clear goals for the tuck-in, not having that clear goal of saying, I want to cross-sell this service into my customer base, or not having a clear plan about how to actually execute on that. So underwriting revenue synergies that don't actually materialize. And then, when we don't actually have real buy-in from the platform management team about the tuck-in, and we say, hey, we think this one looks great, we're going to do this acquisition. And then we hand it off to them. and then they go, whoa, what are we doing with this? It creates this issue where no one's really accountable for the post-close performance, and you end up having a tuck-in sitting there in limbo. So, to summarize, they're great tools when used well. They can add a ton of value to the platform, but you got to have a thoughtful strategy for it.
Tommy Cooperrider, thank you for that insight. Stuart Coleman from Superstep, what are your insights?
Yeah, at Superstep, we have add-ons as part of most theses that we're working on and platform underwrites. That said, we are typically backing businesses that we think have a very large organic growth profile and opportunity to drive this significant majority of the return. Our underwrites, I would say, have probably less than half a turn that's focused on add-on M&A and attributable to add-on M&A. It's the majority is what can we do organically with the business. That said, we're looking to typically do 1 to 3 add-ons, and we could do more for sure. When we get that wrong, I would say there are kind of 2 places that happens. One is backing the wrong management team that doesn't want to be part of a platform. Probably should have sold to a strategic that didn't have a longer hold period, and we weren't aligned from the beginning. I think that's always something that we collectively need to be careful about. We've seen that happen, and there's not a lot you can do with it. I'd say the other one is how complementary are the services that are coming in to the existing business. And it doesn't have to be just a capability expansion. It could be a new vertical or a new geography. But to the extent that you can bring something that is additive to the portfolio of what you're selling or the verticals you're going after, or you're getting into a new market, it reduces the kind of internal competition that can be created when you buy a business and erode culture, right? At the end of the day, that's really what we need to protect. We're very focused on building great cultures at Superstep, and we think that's ultimately what leads to successful outcomes.
Excellent. Stuart Coleman from Superstep, thank you. Jamie Kennedy from Griffin's Wharf, what are your thoughts there?
Yeah, so at Griffin's Wharf, we actually, in our underwriting, the entire return is driven by the base business. So every platform has to clear a 3x net MOIC within 5 years on a standalone basis. So again, we're not underwriting any bolt-ons. We're not underwriting multiple expansion. That being said, we are buy and build investors, and we're typically looking to target probably 2 to 3 bolt-ons per platform. We think that synergistic M&A can add to incremental return, but what it's really doing is compressing your hold period because it gets your platform to where you want it to be sooner. So we're always doing that buy versus build calculus, and every deal is a little bit different. But we're underwriting our underwriting is based just on that organic base platform, the organic opportunities for that base platform. Where we have gotten it wrong, and it's difficult not to, is in modeling. Our bad joke is that every model is always wrong, but we try and put the best information we can and update it constantly to make sure that at least directionally we're accurate. What really matters is we want to put in enough conservatism in our underwriting where we have appropriate levers and defensibility to protect the investment when reality kind of diverges from what our spreadsheet says. In our view, reality tends to move in step functions where models tend to model linearly. So we always are doing, postmortems. We're updating our numbers as real-time information comes in because we need to use our models as a mechanism to test our thesis in real time. But again, we know that they are limited to the accuracy of the data that's going in up front.
Jamie Kennedy from Griffin's Wharf, that's really great insight. Thank you for sharing it. Ryan Schmidt from Court Square, what are your thoughts?
tuck-ins should accelerate a core thesis in our view. It should never substitute for one. So we want the base business to carry out the thesis ideally, and tuck-ins become an accelerant. So again, not the core reason the deal works, but incredibly important. And there's an M&A function or capacity in every one of our investments. But if the standalone business doesn't work on its own, I think the thesis is just generally too fragile. M&A can add a lot of value, but I think people overlook execution risk, integration risk, timing risk, all these different things that can impact the business. It's super easy to model roll up M&A on paper. You can model the value arb. The math makes sense, right? But again, what's overlooked is it's really hard to source the right deals, to pay the right price and buy them well, to align the right incentive structures to incentivize those founders who are rolling into your business to stick around, and then integrate as well, right? Like a lot of these businesses are services, people-based businesses, and integrations are not easy. The biggest thing that we've overlooked in the past, and you don't always get these right, but you underestimate the organizational burden at the acquired company, yeah, right, but also your portfolio company. So you need to make sure when you invest, or at least over time, you need to build the right capabilities internally at the portfolio company from a leadership capacity perspective, from a systems perspective, and operational discipline to make sure you increase the chances of success of a successful M&A transaction.
Well said. Brian Schmidt from Court Square. Thank you. Bill Summershield from Keystone. What are your thoughts?
Yeah, I think, look, there's no hard and fast rule, although I would tell you our strategy is what we call a buy and build strategy. So we're always investing in supporting organic growth and strategic initiatives in that regard. But we do want to be investing into markets where there's an opportunity to grow and develop a business using acquisitions as a catalyst to fulfill whatever the strategic imperatives might be for that business. So if you think about kind of the going in, modeling or base case that we would build, I would tell you it's pretty close to 50-50. We always look at it, hey, if we never do a deal, are we going to be successful and what does that look like? And then if we do a pretty modest number and scale of acquisitions, what does that look like? I think, we at a minimum are trying to produce, kind of 3 times our invested capital in any deal and any strategy that we choose to pursue. That's kind of our minimum baseline threshold. And, you'll typically see it, 3.5 times in how we think about that, acquisition driven tuck-in oriented portion of the model. Look, I think if you look at our outside successes, I think it's generally where we absolutely nail the add-ons, right? Both in our ability to go execute against them, the availability of them, and then the value enhancement and in kind of strategic mindedness of how those come into the organization and produce then outsized organic growth. So where we're producing 5+ times our money, that piece really hits. Look, I think on the risk side and kind of what goes wrong, I think if you're going to do M&A, certainly in larger scale M&A, where it's not tiny little tuck-ins, but you're doing bigger strategic deals, you got to hit. I think a bad deal, which we've all done, puts you in the penalty box, and it frankly can take 18 months to kind of get through that and salvage what you can from that, or reposition it and get back to that growth mindset, right? So I think that's kind of a prerequisite to our strategy. And then I think where we've also maybe gone wrong or where we're not as successful, is alignment around that owner's mentality, right? And respect for the core of the business that attracted us to us, but a willingness to introduce, again, those more sophisticated ways of operating. And so generally that's why people partner with us. And that's really something that we're looking for, but in the off chance that you get an entrepreneur where, when all is said and done, ultimately doesn't really want to evolve the way that they're operating, that again is somewhat necessary to scale a business. You can have challenges in generating, those types of outcomes.
Bill Summershield, thanks. Great insights. Chad Scripps from Black Lake. What are your thoughts?
Our view at Blacklake is that a business thesis and an investment thesis must stand entirely organically. Tuck-ins, add-ons, those are viewed as kind of icing on the cake. I think it's very easy to make an acquisition look good on a spreadsheet. I think we all know that larger businesses, particularly in this part of the middle market, as you get larger, you have less concentration around vendors, people, customers. All those things are really good for exit. You also have more scale, which introduces you to a bunch of bigger buyers who are willing to pay more. That's good too. So on the spreadsheet, it almost always works. Our concern is that the things on the other side here, the non-numbers things, the relationships, the culture, the things that your business founder has spent decades building can be destroyed so quickly with a bad acquisition. I have seen no faster way to destroy value than doing an acquisition that sure sounds good, but the folks just aren't a good fit. And so that is really the lesson we have learned is it really has to be something where the organizations seem to really work well together. They seem to gel. They seem to have things that they want to talk about and work on together, because the idea of just sort of making the numbers work kind of never works. And the other thing that we struggle with is if you do a thesis around acquisitions, and we can't control what businesses sell for in the marketplace, just like we can't control what businesses are for sale and what other companies are in that industry. If we can't find the right add-on, we're at a bigger risk of doing the wrong add-on at the wrong price if that's what we predicated our investment on. However, if our investment is predicated on organic growth, and then we can find acquisitions that help us sort of enhance that organic growth, that's really where those acquisitions become compelling. So we look at our 3 most recent exits. One business had 3 on acquisitions, one had 2, and one had 0. And the one with 0 acquisitions had the most growth from the time that we made our initial investment to the time we sold, roughly 11-fold growth in revenue, all inorganically. And so we didn't do any we didn't do any acquisitions there because we were growing so rapidly organically. We didn't want to screw it up. And so I think it really has to be case by case.
Chad Scripps, great insights. Thank you. Lee Minkoff from Renovis, your thoughts?
So when underwriting the new platform, especially for a new platform, we are laser focused on that end market, that asset, that management team, and really the next 30, 60, 90 days of that platform, what we need to do, the execution that we need to do to sort of onboard it into a Renovis company. In reality, I would say within professional services at Renovis, not for all segments of Renovis. So Renovis, 4 segments: education, healthcare, IT services, and professional services. Within the professional services vertical, we have done a ton of add-ons. We are doing an average of 6 to 7 add-ons per company. So while from a prudent underwriting standpoint, we're probably underwriting the majority of the growth to come from that original platform, because it's hard for me to say, hey, we're actually going to do 6 or 7 add-ons, even though in reality we have. But I'm not going into my initial IC meeting saying, hey, we're going to go buy six more companies after the original investment. But over the last 5 years, 4.5, 5 years at Renovis, that is what we've done. And when you look at the math, yeah, actually the majority of our returns have come from the 6 add-ons on average that we've done after the first platform. Now, it's hard to calculate that exactly, because if we didn't do the initial platform, we wouldn't be in the game, which we talk about, like, let's get in the game. And that's when it goes back to your first question around, we don't need a perfect business, right? We don't need the perfect business to be our first platform. We're willing to buy an add-on type asset to get in that end market that we really want to be in. And we've done our work to make sure that the fragmentation of targets in that end market is at a level where we know we can go out and buy additional companies in that space. So I wouldn't say like, it was wrong. Like, I think we've underwritten these platforms to account for the majority of the return on that investment. And that is like prudent underwriting. And because you don't want to make an investment and be like, oh, for this to be a success, we need to go buy 6 additional companies. It kind of sounds a little bit ridiculous in an IC meeting, but in reality, we've done that, and I think we've generated a strong returns. I'm gonna have to always be careful what I say, but we generated very strong returns for our investors, and that is, I credit that to a high level of add-on M&A that we've executed for our initial platform companies.
Lee Minkoff, thank you.
Thanks, Todd.
So I think that's great insight. And it's great to hear it directly from private equity investors rather than consultants or advisors, or to hear it from the guys that control the checkbook, that do the analytics, that make the decisions, I think is very informative as we think about how we want to maximize the value, not only of our initial transaction, but future transactions as well. Again, I'm going to say thanks to the folks at Tower Partners, voted by Axial as the #1 lower middle market investment bank in 2025. I hope you enjoyed this series. We've got 6 of them out there, so go track down the others.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.